What's going on, guys? Matthew Minnis here. Welcome back to the channel. In today's video, we're going to talk about the most powerful investment tool that you guys have that most people don't take advantage of. If you were to ask me, or you ask my mom or dad, today what our biggest financial regret is, we would tell you the same exact thing. It's not contributing to an HSA earlier and not investing the funds that are in an HSA or a health savings account. The health savings account is the single most powerful investment tool you have to setting yourself up for financial independence in the future. It does not matter how old you are. You can be 18 years old, you could be 60 years old, you still have time to take advantage of this. In this video, we're going to talk about what a Triple Tax Advantaged health savings account is. We're going to go over the maximum contributions that you can contribute to it. We're going to give some examples of how much money you could potentially be making out of your HSA. We're going to do some comparisons of a traditional plan versus a high deductible health plan because only one of them allows you to take advantage of an HSA. And as a bonus, if you stick around to the end of the video, I'm going to give you guys a tip that could potentially save you guys in a tight situation in the future. You might come across some financial troubles and you might need some extra money. Well, this tip, not many people know about, you could take advantage of and set yourself up for success. But before we go into the video, I do have to say that I'm not a financial advisor. This is not financial advice. This video is just meant to entertain and inform you. It's up to you guys to do your own research and then come up with your own financial plan. So first things first, what exactly is a health savings account? Well, an HSA is a highly tax advantaged account that allows you to save money and then you can later use that money to pay for qualified medical expenses. An HSA is an account that is not available to everybody. You have to qualify in order to have one. You have to have a specific type of healthcare plan, which is generally a high deductible health plan, not a traditional. Now in 2022, in order to qualify, you have to have a minimum deductible for an individual of $1,400. One thing to note, an HSA is not the same thing as an FSA or a flexible spending account. When you have an FSA, the funds are gone at the end of the year. You have to spend the money. With an HSA, the money is yours once you have it. You can transfer it, doesn't matter who you're working for, you can move it to different brokerages, it does not matter, it's your money. Now the great thing about an HSA is once you hit a minimum threshold for dollars available in the account, depending on the company you're going with, you can actually invest that money into certain funds or securities or assets. And now, even though you can invest the funds in your HSA, this is crazy, only 9% of the people that have an HSA actually invest those funds. So 91% of the people are not taking advantage of any compound interest. 55% of people don't take advantage of any of the tax advantages. They don't even contribute their own money to this fund. It's crazy. So why is that? Well, my personal opinion is it's just lack of education. They don't teach this stuff in schools and a lot of parents don't know about it. So kids my age, we just don't know. So hopefully at some point they decide they want to learn how to get rich and they start looking up YouTube videos on personal finance. But anyways, let's look at the numbers. We're going to look at some examples of if we invested money from an HSA into certain funds and over a certain amount of time and just see what happens. So for the first example, we're going to go through it step by step and then I'm going to show you a bunch of examples on a spreadsheet. But for this one, let's just say we have $0 in our HSA. We're going to contribute for 30 years because we're going to start at the age of 35 and we're going to go until Medicare at 65. So we have 30 years for our money to grow. We're going to do the maximum contribution for 2022, which is $36.50, $50 more than last year. So we'll type in $36.50 and it's going to compound annually. And all of a sudden, at the end of 30 years, we're going to have $413,000. How much did we actually contribute? Well, we only contributed $110,000. So we made or profited $303,000, assuming an 8% return, which is actually pretty average. Now, this is a perfect world example, okay? Let's look at some more perfect world examples. And when I say perfect world, I mean that even though you're paying your monthly premiums for your high deductible health plan, you are contributing to your HSA and you're not actually spending any of that money. So anytime you go to the doctors or you need some type of medical intervention, you are spending your own out-of-pocket money. You're not using your HSA because you know if I invest the HSA money, it's triple tax advantage. If I invest my own money and use the HSA for the medical stuff, then I'm going to pay taxes. So that obviously would make no sense to do that. So in the perfect world examples, if an 18-year-old individual decided to invest until he's 65 or she is 65, 47 years, she would end up with $1.65 million with $1.5 million in profit. That is insane. So if you're 18, you got a lot of opportunity. But maybe you're a little bit older, maybe you're 45. You still have 20 years, you got plenty of time. You can actually contribute beyond the age of 65. We also have some family examples. Let's just say that you're a family, you're 35 years old, you can actually contribute up to $7,300. We invest for 30 years, we end up profiting $600,000 that we did not have if we had just let it sit in our HSA. So as you can see, this is pretty powerful, especially since you do not pay taxes when you take these out, as long as they're used towards qualifying medical expenses. We'll talk about that more a little bit later. Let's do a realistic example though. What happens if we are a 35-year-old individual and we decide we don't have quite enough money to not use the HSA at all? We hit our high deductible and we had an extra $1,000 expense. So we spent $2,400 of our $3,650. We only have $1,250 left at the end of the year, and we're just gonna say that this happens for 30 years. Obviously, some years might be better, some years might be worse. But at the end of 30 years, you still have $142,000, even with spending some money from your HSA, which, as I said, you would only do that if you have to, but just as an example. Now, if you wanna look at these more in depth, feel free to pause the video and take a look. So now that we just looked at those examples, we need to realize that that is only part of the picture. Because remember, this yearly contribution can change. If it goes up and you decide to keep maxing it out, the more money you invest, the more money you're gonna make. Also, if you're over the age of 55, you can contribute an extra $1,000, allowing you to invest more money, therefore grow more money. But let's just take a second to compare an HSA to a 401k or a Roth IRA. Well, the 401k, you're putting in the money pre-tax, which is the same as the HSA. 401k often offers an employer match, which you have to take advantage of. But with the HSA, same thing. A lot of times employers will give you a contribution by doing certain things. My old company, if I got one physical per year and I went to a gym, I had a gym membership, they gave me $1,000 into my HSA. So $1,000, free money just for doing those two things. But when you go to pull the money out of a 401k, you have to pay income tax. When you go to pull money out of an HSA, you don't pay that tax. It's like a Roth IRA in that way. However, with the Roth, you pay the money up front. With the HSA, you're not paying those taxes. You do have to remember though, if you pull the money out for something other than qualified medical expenses, you're gonna face a 20% penalty on top of your normal income tax. Do not do that. That is a terrible waste of money. 20% is ridiculous. But I did say I'd have a tip for you later on in the video, and we are getting closer to that. The last thing I want to mention real quick about those contributions, and also comparing to, for instance, a 401k, is when it comes to the employer contributions plus the employee contributions count towards the annual maximum. So if they give you $1,000, you can only do $2,650, which means less money coming out of your paycheck. Now that's different from a 401k because employer match does not count towards your annual contribution limit. So now let's just talk about, should you actually do a high deductible health plan or a traditional plan if you have those options? We're just gonna look at the math. I have an example, and just remember, this is just an example. You would need to plug in your own numbers to determine what's best for you. So which one should we choose? High deductible health plan or traditional? Well, with the traditional, typically you're gonna have higher premiums, but lower cost per visit. You'll have copays. With a high deductible health plan, you'll have lower premiums, but a high deductible you need to hit. But one thing to keep in mind is if you're a healthy individual, maybe you're younger, you don't have any underlying health conditions, you're probably not gonna go to the doctors that much. There's been times where I only go to the doctors once for my yearly physical. There's been times, not saying that I'm proud of this, where I didn't go to the doctors at all. I probably should have. However, if we just look at a random yearly cost, if we were looking at $240 a month and we spent an extra $800 on visits, we spent $3,680. If we went with traditional, which was $350 a month, we didn't spend any extra money, we still would have paid $4,200. So in general, the high deductible health plan would have been a better decision for me, and that doesn't even include the fact that I can invest all that money tax-free. There is so much information that's available and that we could just talk about for hours when it comes to health savings accounts, but to keep this video shorter, I just want to go over one more thing. According to research, the average retired couple from the age of 65 until the time they perish spend around $300,000. So if you have an HSA with $750,000, you can start to decide if you want to actually start using your money for things other than medical expenses. If you do that at that point, then you're not going to face the 20% penalty. You can withdraw the money and it'll just be charged as normal income tax, just like a 401k. That's why I say that an HSA is better, because if you're using it for medical, you gain the advantages of the Roth. And if you're not using it for medical, then you still have a powerful 401k or traditional IRA. Now, if you're still watching the video, I said I'd have a tip for you, and this is pretty cool. There is no time limit when it comes to asking for reimbursements for qualified medical expenses. As long as you had an HSA at the time of the expense, then you can request money back for that. So if I had surgery 10 years ago, and all of a sudden I'm a little short on cash this year, I can go and submit the expense as long as I have evidence, and I can get that money now. It could be 20 years ago, does not matter. So the best thing to do is anytime you have a qualified medical expense, save the receipt, take a picture of it, scan it, put it in a PDF on your computer, save it in a folder called Health Expenses, and just add to them over the years. And then if you ever need to take some extra money out, use that so you don't pay the 20% penalty. So all in all, if you're still watching this video, make sure you leave a comment down below. Let me know if you have an HSA or if you learned anything today. I had two goals with this video. One was to show you the power of investing in an HSA, which most people don't know to do. And the second thing was to show you that you have options. The HSA is not the best answer for everybody, but it is a great tool for a lot of people. It's up to you guys to decide what's best for you and your family. If you haven't already, make sure you smash the like button, subscribe to the channel. We are so close to 669 subscribers, which is obviously the next goal. We do weekly videos on anything finance related, and I hope to see you guys in the next video. Take care.